Good morning, everyone. Thank you so much for joining us today. If we haven't met yet, my name is Courtney Hartman, and I am one of the group health specialists in the Health Plan Options Department at URL Insurance Group. So please do not hesitate to reach out to me or anybody on my team for assistance with anything in the group health market. Now that everyone is familiar with who I am excited to welcome Rocco, who will be going over Mutual of Omaha's group life insurance. I hope you find this session valuable. Thank you again for being here. And without further ado, I'll turn it over to Rocco so he can introduce himself.
Thank you, Courtney. Hello, everybody. For those of you who have not met me, like Courtney mentioned, my name is Rocco. I'm with Mutual of Omaha. So I partner with brokers in the central and eastern Pennsylvania area. Oh, Ashley says she can't hear me. Are you still able to hear me, Courtney?
I can hear you. It is breaking up a little, but I can still hear you.
Of course. It's working perfect before, and now we're having issues.
Some people can hear you, some people can't hear you.
Huh. Okay. Let me see if I can switch my audio.
All right, we got some mixed reviews here on the hearing.
Okay, let's try this. I switched my mic. Is this any better?
I'm seeing yes. 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 Okay. Perfect. Yes. Wow. I can hear you now. Okay.
Everybody. All right.
We're in business. Perfect.
There we go.
Yep. Take it away.
Everybody's good now. Sorry about that. And thank you all for the feedback. Appreciate it. My name is Rocco, as Courtney kindly introduced me. I am with Mutual of Omaha. So I partner with brokers in the central and eastern Pennsylvania area for ancillary group benefits. So group life, short-term disability, long-term disability, dental, vision, accident, critical illness, hospital indemnity, and absence management. We offer all benefits as employer paid and or voluntary or contributory. So I appreciate all of you joining today's call. And this presentation is for 2 CE credits for diving into group life insurance, which is supposed to take 2 hours. It is not going to take 2 hours, just to give you a heads up. So that is good news. But we will have a sign-in sheet, hopefully to you all tomorrow, but certainly sometime this week. And it does ask for a time in and time out, as well as, of course, your name, signature, and license number and all of that. But for the time in and time out, make sure that you do put 10 a.m. start and 12 p.m. end so that you can receive the full 2 credits, all right, even though we're not going to take that full time. So, all right, diving into group life insurance. So this presentation is going to go through some of the fundamentals and provisions that are within life insurance, group life insurance products, some of them with which you might be very familiar with already. Some of them it'll be a good refresher. Some of them maybe you haven't heard before. But I hope at least 1 or 2 good points that you're able to get from this presentation that you can take to your clients and feel more comfortable explaining and help you win new clients or retain current clients for longer periods of time. So to start out, group life insurance is something that is offered to employers, 2 or more employees in size. And it is, of course, going to be assessed based on level of risk, the group size, and a number of variables that we take into consideration. It's different from individual life insurance because when we're looking at individual life insurance, of course, we're going to be reviewing and assessing or underwriters rather, will assess that individual's health, their health history, their current level of health, whether they smoke or do not smoke, and all of these types of things that are not considered for group life insurance because of the law of large numbers. The risk is spread across a larger number of individuals, which allows for less scrutiny for individual health and more so assessing the group as an overall whole. So if anybody wants to maybe utilize the chat, I think would be the best way to do this. But what are some thoughts on what an underwriter for group life insurance would be reviewing from a risk perspective to determine the cost for a group's life insurance coverage? What are some of those factors? I see age, gender, group size, tobacco, medical conditions, the industry, ages, gender. Age is a common denominator here, which is spot on. Of course, that's going to be the biggest one. Now, someone did mention tobacco and medical conditions. So there are some group life policies, usually on a voluntary basis, meaning paid for by the employees, where they will include different rates depending on whether they are tobacco or non-tobacco, but not all carriers do. And Mutual of Omaha, we do not. We usually just provide one set of rates regardless of tobacco status. And then medical conditions really are avoided from having the group life insurance and that spread of risk, unless there's an individual who wants to elect an amount over the guarantee issue amount, which then would require a medical questionnaire referred to as evidence of insurability, where we would review those medical conditions. But again, that's one of the advantages of group life insurance, where we don't really have to take into account any individual's medical conditions or health history in order to provide that coverage. But all of the others, the age, gender, group size, industry, spot on. So, my arrow keys don't work for this. That's okay. Okay, so here are the bullet points that we would take into consideration, or the ingredients that we would use to sort of bake the cake, which is our proposal and the rates that we're able to produce, we being group insurance carriers. So it's group type, industry, geographic location, believe it or not, does have an impact on the cost, and we'll get into that in a couple of slides. Occupation is not necessarily taken into account for life insurance, but definitely very, very important for disability. And then age. Age really should be number one. If we have a group of 20 employees and 90% of them are over age 50, that's going to have a drastic impact on the cost relative to a group where we have 20 employees where 90% of them are between ages 20 and 30. So in order to bake that cake, we're going to look at the average age of the group, the age of the oldest employee, those other key risk factors listed at the bottom underneath the green section really are for individual life insurance and don't necessarily apply to group insurance. If I could have changed these slides, I would have, but they are approved by the state and I'm a little limited here, so bear with me. But I will point out those key differences. But really those sections underneath the blue and the top are the main things that we'll consider for group life insurance. Volume distribution is another key item to keep into consideration. So a lot of times we might have a group where, again, let's use that 20 life group example. Maybe 5 of those employees are executives or key members of the team or management employees, whatever it might be. And that group is looking to provide those individuals with a higher life insurance benefit than the other class, which is maybe all other eligible employees. Or maybe we have salaried employees and then hourly employees, whatever it might be as that class differentiation. But if we have that instance, and maybe they want, the group wants for those 5 executive employees to have, let's say, $150,000 of life insurance coverage. And then all other eligible employees, the other 15, maybe they want them just to have $10,000 of life insurance coverage. That would result in what we would refer to as an unbalanced plan design. So we want to make sure that we're keeping that in consideration, where we don't want to have a very small percentage of the group's population with most of the volume of that life insurance coverage. right? Because then it's more or less kind of providing strong individual coverage to that small subset of employees at the advantage of having the spread of risk and the group rates, because having that spread of risk drives costs down, but really puts a lot of risk on the insurance carrier, right? If 3 of those other employees were to pass away, that's $30,000 of life insurance paid out. Whereas if only one of those 5 executives passes away, that's $150,000. So it's not an equal spread of risk. Not saying it has to be the same benefit, but the delta can't be too far. So again, this presentation mentions that occupations are a risk factor taken into consideration for group life. They are not. They would be taken into consideration for individual life insurance, but if you are looking to provide coverage for one of your clients or a new prospect for life insurance, and there's no disability being requested or that you're trying to offer, occupations aren't necessarily required. It would be nice to have, but it really is not required for providing the life insurance. But where it is sort of taken into consideration is just the overall industry. I mean, the example here is if we have a construction company versus, let's say, an accounting firm, they're going to have, the construction company is going to have a much higher risk of death versus the accounting firm. So we do take into consideration the overall industry, but not every individual occupation within the group. Area. So again, believe it or not, different states, even different zip codes, are associated with different levels of risk. And the example that we use is if you think about maybe a place like Vermont, where a lot of folks are eating very healthy and there's Cliff Bars and granola bowls and all these things, versus another place where folks might not be eating as healthy, and it's just maybe a very busy city area, or just a lot more going on and not as much nature around. Things like that are taken into consideration based on the zip code, which goes into baking that cake and has an impact on the overall risk of the group, and of course the cost and the price. So experience information is something that comes into play with group life insurance for groups with over 500 employees. So you may have had some involvement with groups over 500 employees in the past, or maybe some of you may have not, but it's very crucial to understand the importance of why experience information is needed regardless, and really what purpose it serves, right? So if we think about a group of our 20 employee example, and they've had group life insurance for 5 years, the way that a group insurance carrier would look at that is we'll say, all right, 20 employees, and maybe it's been 20 exactly for all 5 years. They've had that coverage for 5 years, so that's 100 life years, right? Because we can say, all right, based on the last 5 years, you've had 20 employees covered for that entire time. 20 times 5 is 100 total life years. Well, we are not confident, we being all of the actuaries within the group insurance industry, are not confident based on just 100 life years that we're able to confidently predict how many life claims we could expect over the next year. So once we have 500 employees and 1 year of those 500 employees being covered, that's 500 life years. And that's the point where the life insurance becomes credible. Not fully credible, but now our actuaries and underwriters and reps can say, okay, based on 500 employees being covered, we have a certain percentage of confidence of how many claims we can expect moving forward, right? If they had maybe 3 claims over the last year, we can expect maybe with 30% confidence that there would be 3 claims in the next year. Now, in order to be fully credible, where we can say, all right, we have 25,000 life years, and that's the level of where life insurance becomes fully credible. So maybe that's, that 500 life group over oh gosh, however many years that would be. I can't do that in my head that quickly. Or maybe it's a group of 25,000 employees for just 1 year. At that point, we would be able to say, all right, this is the amount of claims that have been paid out. These are the number of claims that have occurred. We are 100% confident in basing our rate off of what that experience data tells us, right? If it's less than 25,000 life years and it's not fully credible yet, we're going to take it into consideration, but we're also going to use our system's rate that it gives us and blend the two. If anybody has any questions at any point, feel free to put them in the chat. I have it up here on the side, so I am monitoring it, and just let me know. Okay, so we already talked about this a bit, right? How you can have different coverage levels for different classes of employees, executives and all others, or salaried and hourly, etc. But the difference in coverage levels cannot be excessive. Every group life insurance plan has to have a maximum. Now, they can structure it where it's a flat benefit. Maybe it's a flat $100,000 benefit, or it could be a multiple of salary plan, where maybe it's 1 times annual earnings up to 100,000, or 2.5 times annual earnings up to 100,000. But the size of the group, the ages, the average ages of the group, the oldest employee, the industry, the location, all of those things are taken into consideration when seeing what is the highest maximum that we can provide. Now, something else that I do want to point out quickly, it's not discussed necessarily in this presentation, but is very important for you to know and for all of us to know as consultants in the industry, is any amount of group life insurance paid for by the employer, fully paid for by the employer, that is greater than $50,000 of coverage is viewed as imputed income, and the employees are subject to taxability or taxes from that amount of group life insurance above $50,000. So a lot of times we'll meet with groups, right, that don't have any group insurance in place. And the purpose of group insurance is to help attract and retain talent. Life insurance, group life insurance, is going to be the easiest, most affordable benefit that they can offer for their employees if they were to pay for it, the employer was to fund it, versus maybe a dental or a disability plan, right? So if we want to make sure that we're helping this employer enhance their benefits package, attract and retain more talent, but they don't have a lot of funding or budget for it, life insurance is by far the best and easiest place to start because it's the most affordable. Usually, employers will fund at least some amount of employer-paid life insurance. Maybe it's $10,000, maybe it's $25,000, or $50,000, or $100,000. But it's also really important for those groups to understand that they can offer group life insurance on a voluntary basis as well, meaning it's employee paid. Even if they are funding some amount of employer paid life insurance, well, they can offer employee paid life insurance as well, that the employees can purchase additional, right? And that also, with Mutual of Omaha and a lot of group insurance carriers out there, are able to provide lower cost rates for the employer paid life insurance if there's additional benefits attached to it, including that voluntary life insurance. So I do see a question in the chat. So for $50,000 plus group life policies, does taxation apply to retiree group life as well? So that is a really good question and sort of nuanced. I have not come across that before, and the reason being, when we have retirees covered under a group life plan, it's almost 99% of the time going to be a very small benefit, usually $15,000 or less. The only group retiree plans that I've seen, honestly, are $5,000 or $10,000. So I don't know of carriers or plans that, at least in our territory, meaning New Jersey, Pennsylvania, and Delaware, that offer retiree coverage on a group basis at or above 50,000. So I don't anticipate that coming into play. And I don't know how to answer it. I don't want to give you an answer for sure because I don't know and haven't come across it, but I don't anticipate that really coming up because again, retirees usually have $5,000 or $10,000 of coverage on a group basis. Okay. So this next section, the fundamentals of group life insurance, we're going to be looking at guarantee issue amounts, EOI, which is that medical questionnaire that I mentioned earlier that, if somebody wants to elect above the guarantee issue amount, they would have to submit, and some other provisions that are included in life insurance. Again, some that you might have heard before, some that would be a good refresher. That last bullet point there, which is the very last slide of the presentation, the takeover, that's another really crucial part of the presentation that I'll highlight as something that we all need to be very experienced on and involves a lot of consultating with our clients, but we will get to that. Okay, so starting out with guarantee issue amounts. Now for employer paid benefits, usually all amounts are going to be guaranteed. It's very, very rare that we would have an employer paid group life insurance plan where maybe there's a $300,000 max, but only $200,000 is guaranteed, and employees have to submit evidence of insurability for additional. This more so is going to come into play with those employee funded life insurance benefits, where maybe there's a $100,000 guarantee issue amount, but the max they can elect to is $300,000. Well, all employees during the open enrollment period can elect $100,000 just by checking a box and signing their name. It's automatic approval. Or they can submit that health questionnaire or evidence of insurability form if they wanted to elect $150,000 or $500,000, whatever it might be. In those open enrollment periods for those voluntary life insurance benefits, if there is an employee who maybe submits that evidence of insurability for $500,000, and they're approved, they get the $500,000. If they're denied, they would still receive that guarantee issue amount of coverage of $100,000 because it was during that open enrollment period, right? So this is a question that comes up a ton, at least for me, in a lot of enrollment meetings that I've done where employees ask that question, hey, I want to elect more than the guarantee issue amount. How's that work? Well, you submit the form. One of two things will happen. One, you're approved, great, you have the coverage. Two, you're denied, well, hey, you'll still have the guarantee issue amount because you're in this open enrollment period. Now keep in mind, Mutual of Omaha and I believe all group insurance carriers out there do only offer that initial open enrollment period, the first time that the coverage is taken over to that carrier for voluntary life insurance, and it's not offered every year. So that's another question that comes up a ton, where HR managers, employers, CFOs, and employees might think, I'm going to pass on this coverage this year. I'm just going to enroll next year, or wait until something might happen and I'm diagnosed with something and then I'll enroll. Well, then you're going to have to submit the evidence of insurability, right? It's only offered on that one-time basis almost every time. Again, that evidence of insurability form is a health questionnaire, asks those questions about health history, etc., which is commonplace for individual life insurance, but only comes into play with group life if you're electing over that guarantee issue amount. Sometimes we might approve an evidence of insurability form based off just what's included on that health questionnaire. Sometimes we might deny a claim based just what's provided on the health questionnaire. Sometimes we might be in a situation where we don't necessarily want to deny the evidence of insurability right away based on that info that we have. And we might say, hey, we will work with you to have a paramed come to your house and do some further examinations for review because we feel we might be able to approve you and we don't want to deny you just yet. So that's another question I get a lot, like, hey, what's all involved in this evidence of insurability process? Do I need to do these exams? Do I need to do a urine test? Do I need to get blood work done? All of these things. The answer is it depends, because it's different for different situations. They may be approved or denied right away, or we might say, hey, we're going to do some further evaluations before we make that determination, which is for their best interest, right? We're not always going to do them, but we also don't always want to deny people right away, and we want to give them that opportunity to maybe get approved. All right, waiver of premium. Another really important provision in all group life insurance plans. Now, some of the variables can be different from policy to policy, but most standardly, this is how it's set up. So what waiver of premium is it allows for an employee who's become totally disabled, not terminally disabled, prior to age 60, the ability to continue their group life insurance without payment of premium. Now, usually there's a 9-month elimination period that they must remain totally disabled in order for their waiver of premium to kick in, meaning coverage continues, no premium is owed. This applies to both employer paid and employee paid group life insurance. Now, sometimes you might see that disability must occur prior to age 65. Age 60 is the most common, but it could be 65 or it could be Social Security normal retirement age. And that 9-month elimination period that they must remain totally disabled is the most common, but sometimes you might see 6 months, and more rarely you might see 3 months. Now, when an employee is totally disabled, and let's say they're on a short-term disability plan, Mutual of Omaha does do a courtesy review to see if they should transition to long-term disability. If there's an employee who is transitioning to long-term disability or applies for long-term disability and is approved, Mutual of Omaha also does a courtesy review to see, well, does this individual have group life insurance? And if so, we're going to do a courtesy review to see if they qualify for waiver of premium. But maybe they don't have any disability policies in place. It's very, very important that groups are aware and employees are aware that if they are not actively at work and they are not working part-time at all, even if they're not sure if they would be considered totally disabled or not, they should submit a waiver of premium claim, because if they are not working and they were to pass away, it's important to make sure that they have that coverage, and also that the employer doesn't have to worry about whether they're covered or not, and also continue paying for an employee that's not actively working, right? So it's a great benefit, but we want to make sure that our employers and employees are aware of what it does and how it works. So what if we have an employee who is currently on waiver of premium and that policy transitions to a different carrier? Well, most carriers, if they've already satisfied that 9-month elimination period and their premium is already waived and it's already been approved with the current carrier, and then that employer switches to a new carrier, the carrier that originally approved the waiver of premium is going to maintain that coverage for that individual. Now, where it gets a little bit tricky, and there's some more nuance, is if there's an employee who is still satisfying that 9-month elimination period and the employer transitions to a new carrier within that period. This is going to be different from carrier to carrier. Now, if that instance happened with Mutual of Omaha and we have an employee, maybe they're on month 4 of their elimination period with waiver of premium, but they've already submitted their claim, we're reviewing it, they're still satisfying the elimination period, and after that 4th month, the employer transitions to a different carrier, we are still going to maintain the responsibility for the risk of that employee throughout the duration of that waiver of premium provision, which is usually to age 65 or the day in which that employee terminates, and we would be responsible for that claim. It's important to be mindful of this because not all carriers do that. Some carriers may say, all right, well, this employee is only in month 4 out of 9 of their elimination period. You switch to a new carrier, we are no longer accepting the risk for that employee. If they were to pass away, we are not paying the claim. And their policies do outline that. So when we get to the last slide here and talk about transition of carriers, this is one of the items to keep in mind for that piece. Reduction schedules is another thing that we get questions on often. Hey, whether it's a new client offering this coverage for the first time and you're having a conversation with the HR manager or the CFO, or if you're in an enrollment meeting and employees say, see, that's the gotcha, right? Then my coverage is going to reduce. What's the point? So the reason reduction schedules are included is so that group insurance carriers can offer this coverage at an appropriate spread of risk to help drive down the cost. The purpose of group life insurance is to provide employees with easy, affordable, and guaranteed coverage while they're actively working. And employees might say, well, yeah, but what if I leave the company, or why are you going to reduce it when I get older? Well, because most employees don't work after age 67. Most employees might not work after age 70. Some people do, which is great, but most of the population does not. And for those folks who do, the group insurance carriers are going to take that into consideration, give them a lower benefit so that it helps keep the cost lower for the overall group, right? The most common age reductions that we see are it reduces to 65% at 65 and then to 50% at 70. This is the ADIA schedule, Age Discrimination in Employment Act, which is something that was put in place federally years ago. It's sort of been outdated at this point. Some group carriers might still include it, but most commonly we'll just see 65 at 65 and 50 at 70. But it's also flexible and can be changed. Maybe it's reduces to 65% at age 70 and then to 50% at 75. Or they could have multiple age reductions. It really is flexible and can be changed. What we normally do is just match the age reduction that's in force with the current carrier. And if there's a request that they want to change it, we certainly can do so as well. All right. The next provision is living care benefits, also referred to as accelerated death benefit. And this is meant to help provide an employee who is diagnosed with a terminal illness expected to pass away within the next 12 months with the ability to withdraw up to a certain percentage of their life insurance coverage while they're still actively living. All right, so that determination is based off of whether they are expected to pass away within the next 12 months. And usually they can withdraw up to 75% of their life insurance while they're still living to use for healthcare so that their family members are not left with that burden, or maybe to take a vacation or just use for whatever they would like during that time. Some carriers might include a different, maybe it's an 80% living care benefit. It is flexible as well, but I would say 90% of the time it's 75%. And of course, that's going to reduce their life insurance coverage. So if somebody has $100,000 of coverage, they use the living care benefit and they withdraw $75,000, they do not still have $100,000 of life insurance. They now have $25,000 of life insurance. So it does reduce their amount. I said 12 months of terminal illness. Sometimes you might see 6 months, but 12 months is extremely common. Conversion. The golden question from employees in enrollment meetings is, well, yeah, but when I leave the company, can I take the coverage with me? So in the states that we normally operate in, Pennsylvania, New Jersey, Delaware, apologies, maybe there's some folks who work in some different states. If so, let me know. Feel free to put it in the chat if you have any questions specific to your state, and I'll try my best to answer them. But conversion is required by law with all group life insurance policies, whether they're employee paid or employer paid, to include. All right, so all carriers have to include this, which allows employees, if they leave the company, if they separate employment for any reason, whether it's retirement, they're terminated, or whatever it might be, they can convert their group life, whether it's employee paid or employer paid, to an individual whole life policy. The cost is going to be different. than what it was while they were an active employee because they're no longer covered under the specific risk of that group. But the advantage is they can't be denied, and they won't have to go through medical questions. They won't have to go through medical underwriting. They can take that coverage with them. The cost is going to increase because it's now an individual whole life policy. And they will have to pay that themselves instead of through payroll deductions or through their employer paying for it for them. But the great advantage is that they get to keep that coverage, right? And they can't be denied. And of course, there's also portability, which is always going to be included in voluntary life insurance, at least with Mutual of Omaha, but isn't always included in employer paid life, but can be. If we see a group that already has portability included in their employer paid life, we will match that, and it can be requested at time of quoting as well. So portability is similar to conversion in that it allows employees to take that coverage with them if they separate employment, but it helps keep the cost down because it ports their coverage into another pool of other ported policies. And the reason or the way that that's able to work is because portability is allowed prior to age 70. So if an employer, or rather an employee, separates employment prior to age 70 and they're concerned about the cost, they can certainly port their coverage. It keeps cost lower. It'll still increase from where it was while they were an active employee, but it's not going to be nearly as costly as if they were to have converted the coverage. Now it will terminate once they reach age 70, at which point they could convert if they wanted to. And one other piece of nuance I'll point out here is if, I see your question, Antoine, I'll get to that in 1 second. If a employee does port their coverage with a carrier, let's say carrier X, and then that employer transitions to a new carrier, carrier Y, that employee who ported their coverage might be subject to terminate based on the policy. So some carriers would terminate any ported plans once that employer transitions to a new carrier. Mutual Omaha does not. If an employee ports their coverage prior to age 70 and then that employer transitions to a new carrier, we're not going to end that individual's ported coverage. The only time it would end is if they pass away or once they reach age 70. So that's essentially the term of a ported policy, is up to age 70. And then for conversion, to answer your question, Antoine, the term is their entire life because it is a whole life policy. So that's meant to provide that individual with that coverage until they pass away, as long as they continue to pay those premiums. Another question from Greg Troop. So Rocco, do you have any statistics on what percentage of covered employees convert the life plan upon termination of employment? That's a good question, Greg. I don't. From just my experience and the questions that I've received from my broker partners and employers on conversion, it seems, my guess would be maybe 20%, and that's heavily predicated upon the age that an employee separates employment. I think that for older folks who might be retiring and reaching those higher points in life, maybe above age 60 or 65, that percentage of those who convert is much, much higher. And that's the majority of where folks convert. If there's younger employees, maybe 25, 30 years old, they might not take coverage with them at all, and it's probably pretty rare for them to do so. But if they do, it makes a lot more sense for them to port that coverage because it keeps the cost lower. Maybe they have family history of medical health issues or something that they're aware of, and they want to build as much life insurance as they can, or maybe they have a lot of expenses they need to account for, and they'll port that coverage. But really, converting coverage is going to be most common for the older population of employees. So it's sort of a roundabout answer there, Greg. I apologize. I don't have a specific for you, but it is a really good question and something to think about for sure. Do the policies have cash value? Another question in the chat. So the Individual whole life policies can accrue cash value when employees convert them, but ported policies do not accumulate any cash value. And there's also no cash value tied to the group plans while the employees are actively working. So that would really only come into play if an individual separates employment and they convert to that individual whole life policy. So another question on the tax liability for amounts over 50,000, who provides the statement of taxable income? So that is the responsibility of the employer. Now, most employers will have, of course, a payroll vendor, and that is something that payroll vendors are very familiar with, and they usually will handle that taxable income, which again is referred to as imputed income. So it's the employer's responsibility. The group insurance carrier is not going to provide any detail on the amounts of the taxable income. We are supposed to, I always do, advise about the taxable income that's associated with that. But it is up to the employer to make sure they handle that, again, usually with their payroll vendor who handles things like that all of the time. All right, so going back to something that we sort of touched on earlier in the presentation, the retiree coverage. Not as common in the group insurance market, but maybe we'll see this more so when dealing with municipalities, townships, public entities, etc. It's a completely different risk, right? Because the group insurance is meant to cover active employees, but maybe we have an employer who is really, cares about their employees, or it's a public entity and they want to provide retirees with some level of coverage. They do have that option. There are factors to keep in consideration, such as the percentage of the overall population that's retirees. We wouldn't want to have a 100 employee group where 90 of them are retirees. Usually it's a small subset of the population and they have a much lower benefit. Here, that example is of $5,000 or $10,000 of coverage if they did work at the company and they then retired. Sometimes employers might put a stipulation on that, meaning they might have to have worked at the company for X number of years in order to be covered under their retiree coverage. This is 100% of the time going to be 100% employer paid. It is not able to be retiree coverage is not able to be offered on an employee paid basis because they're no longer employees and can't be payroll deducted. All right, grandfathering, we're almost at the end here. We're on slide 28 of 30, so we're getting there. So grandfathering is where maybe we have, this is going to come into play most of the time with employee paid voluntary benefits, where maybe there's a carrier in force that has a, let's say, $500,000 max benefit and a $100,000 guarantee issue amount. Well, now that employer transitions to a new carrier who has a $300,000 max and a $100,000 guarantee issue. Well, maybe there were two employees with the previous carrier that had $500,000 of coverage. Well, this employer might say, we don't want to move to this new carrier because their max is $300,000, and we have two employees who have $500,000 of coverage. Everybody else is less than $300,000, but we want to make sure these two employees can maintain their coverage. Well, the new carrier might say, well, hey, we'll grandfather those two employees at $500,000. They can keep their coverage with us, but going forward, $300,000 is going to be the max amount that anybody else can elect. All right, that's what grandfathering is. That's how it's usually going to be applied, which I have seen plenty of times. We have done that before. I mean, most of the time we'll be able to match the plan design in force, but sometimes maybe there's a group coming out of a PEO, which, as we know, can have very, very high benefits relative to the rest of the market for the size of the group that it is. PEOs are usually less than 100 employees in size, sometimes really small, like 10 or 15 employees, but they grow and grow and grow, and then they leave the PEO. But PEOs might have $1 million max life insurance, where there's no group insurance carrier that would offer $1 million max for 20 employees. But maybe there's an employee who has a higher amount, and the carrier might agree to just grandfather that 1 or 2 employees or so. Is the slide deck available to us? So I am going to lean on Courtney for that one, but I'm sure that we will be able to provide this to you all after the presentation. The final slide here is on takeover. So this is what I mentioned earlier. Very important from a liability perspective as a consultant for employers to make sure that you are able to understand the impact that it could have on an employer, on an employee when transitioning coverage from one carrier to another. Now, I don't want to scare you, but again, just want to make sure that this is something that's top of mind, because we, whenever transitioning a group to Mutual of Omaha, we like to have a call with the client to talk through any questions that they have and the paperwork. And this is one of the items that we spend some time on just to make sure that they're aware of how it works. So earlier, remember, we discussed waiver of premium, right? For an individual who is totally disabled and they transition to a new carrier. So all group insurance carriers are going to include, for life insurance, a provision called not actively at work. And if there's an employee or number of employees who are not actively working during the transition to a new carrier, the biggest ticket item that we're going to be looking at is, okay, well, are these employees who are not actively working terminally disabled? Or sorry, totally disabled, meaning they cannot work at all. They're not working part-time and they're unable to perform any of their duties due to their disability. If that's the case, we want to make sure that they have at least submitted a claim for waiver of premium with the current carrier, because the new carrier is not going to pick up coverage for that individual. Now, if the folks that are not actively at work are not totally disabled, they're only partially disabled, then the new carrier will pick them up, most likely. But it's important to ask those questions and say, hey, Mr. Employer, we're transitioning to this new carrier. It's great. We're really excited. We got you some savings. We got you some enhanced benefits for your employees. We're adding this and that. But do you have any employees that are not actively at work currently? Okay. Do you anticipate that they will still not be actively at work on the date of transition? You know, if they're moving to a new carrier on 7/1, are they still not going to be actively at work? They might say, I don't know. They might say, I think so. Well, that's when we would ask the further questions of, well, when was their last day worked? Have they submitted a waiver of premium claim with the current carrier? When's their anticipated return to work date? What's their diagnosis? And that information is what's going to give the new carrier the ability to review and then confirm whether or not we would be able to pick them up and take the responsibility of their life insurance, or if it would remain with the previous carrier. And that, my friends, is everything. So Courtney shared the slideshow in the handouts tab. Thank you for doing that. I'll open it up to see if anybody has any other questions. And again, that sign-in sheet, it's very simple. You put your name, your license number, signature, time in and time out. Now, this was 50 minutes only, but make sure you put 10 a.m. start and 12 p.m. end to make sure you can receive the full 2 credits. Hopefully we'll have that to you tomorrow, but should definitely be by end of this week.
Thank you, Rocco, and thank you everybody again for joining us today. If you do have any questions, please don't hesitate to reach out to us, and we can get those answered. And as Rocco said, I did also share the slideshow in the handouts tab, so that way everyone can download it. So I'm hoping everybody can see that. So you can go ahead and download it, save it. But if you do have any other questions, please don't hesitate to reach out to any of us and we will get them answered for you. And tomorrow or this week, hopefully, we will have the sign up sheet so that way we can send over via email so everyone can get their CE credit. Right, Rocco?
Yes. Yep.
Okay. All right. Well, so for now, until you hear from us again, I hope everyone has a great rest of their day.
Thanks all. Take care.
Thank you, everyone.